OPEC meets on Thursday this week along with their non-OPEC counterparts amid expectations that the two will underwrite a 9-month extension to the current production cap agreement. Many will be wanting to be a fly on the wall at that meeting. Gaurav Sharma is editor at the International Business Times and he joins us now. You're going, of course, to the OPEC conference. I don't know whether or not you're going to be the fly on the wall, but what are you expecting?
Indeed, we'll be there with half the world's media partaking in the section. I think the consensus among analysts is let's say it's an 80% probability that OPEC will roll over the cuts. My personal opinion, or that of my publication, is that I think they will do that because of the complete and utter lack of an exit strategy. They went down the path of cuts to somehow bolster the price. And now how do you exit? If they don't roll over the cuts, which means OPEC will revert back to a 33 million barrels per day quota and upwards. And that will have an immediate response, a downward response on the oil price. So I think they have to cut. Having said so, it's not plain sailing at the moment.
Is it going to be a heated meeting, do you think? I mean, a lot of course, OPEC members themselves obviously have their own opinion. Then you bring in the non-OPEC members as well, such as Russia, of course, the biggest player there. Do you think there's going to be a consensus ultimately amongst them all that it's going to be another 9 months?
My hunch is there'll be a cut, at least on paper. So they'll agree on paper and they'll say we'll roll over this cut, but behind the scenes there'll be some serious maneuvering. Smaller members of OPEC, for instance Ecuador, they've already broken ranks, so they're saying they cannot afford to cut. So we've got the minor members who are breaking ranks. A lot of people suspect Iraq of having broken ranks, is pumping a lot more. The UAE, for instance, they deny it, of course. They say that they're playing their responsible part in the cut and so on. And then there's the internal politics to contend with. Now the Russians, well, they'll play a little hardball. I think heavy snowfall is expected in Vienna on Thursday, so I think the weather is certainly conducive for the Russians. But nonetheless, they're expected to play hardball. And I think what they'll try and do is that they'll say that there should be some concessions, or that there should be a headline agreement by which they can sort of bring their inventories, manage their natural rate of depletion, which is what they've been doing all along, but sort of formalize that and say that this is our contributions. We've been with you for the journey and we'd like to go forward only on this basis.
What about the risk premium that's in the price at the moment? What are we talking about there in terms of some of the unknowns?
You're very interesting you bring this up. We rewind the clock back to 2012, 2013. Before the oversupply completely taxed the oil price, there was a given both in Chicago, in New York, and in London. The traders will tell you, oh, $10 risk premium, that's factored into the price, take it for granted. And then the oversupply neutered it. Now again, this whole conversation about the risk premium has come back into focus. So people are saying, well, will we have that whole $10 to $15 premium? The only way that can happen, and it's a very unlikely event, that Saudi Arabia and Iraq, instead of a proxy war that they're having, have an all-out conflict, which is highly unlikely for the very same reasons, because neither party wants that. It will be self-defeating. In terms of Saudi Arabia's internal politics, it is, as the word suggests, internal politics. Whatever the power brokers are there, and I think that the Crown Prince is odds on to win this particular tussle, and one fine day become king of Saudi Arabia. Whatever we take that on an even keel, whatever the internal dynamic is, and whichever way it goes, hardly any of the players would like to harm the East-West pipeline. As long as that stays intact, that's the key piece of Saudi infrastructure, and supplies don't get disrupted. I don't see how you could revert back to the old $10 premium put back in 2012, 2013, when Iran was everybody's obsession, what the Iranians are going to do, what they aren't going to. Another thing is, again, supply comes into view. You've got a lot of plays, non-OPEC plays, Mexico, Colombia, for instance, and the Americans. Look at the response. We've had 4 weeks or so of rising prices, and in tandem with suddenly the American and the Canadian rig counts start going up.
Yeah.
We had the rig counts earlier this week because of Thanksgiving. So that tells you all.
Yeah. The US, of course, is a non-OPEC member as well, but won't be doubtless at this meeting, are they? They don't involve.
No, they don't send an envoy, but the Mexicans will be there, the Kazakhstanis will be there, and the Russians. I think these are the three main parties we need to look at. There's some others as well, for instance, Oman. Yeah. But these are the three main ones.
Before we take a look at the charts, just want to quickly catch up on that point about the risk premium and where we are in terms of prices, because I'm hearing a lot from economists that they're saying inflation is going to go up considerably. And I say, why? They say, you've only got to look at the oil price. OPEC is targeting $70 a barrel next year. That's the assumption. But you can blow that away?
I'm not so convinced. The first question is who is currently buying into this rally? And a lot of money managers, a lot of fund managers are piling in, thinking that there is a little bit of a geopolitical kerfuffle. There is some strengthening in the market, and the demand is more or less holding up, largely thanks to India. So they think they can drive the rally upwards. Okay, so let's say the rally sustains itself, and of course this is a bullish week. Let's not forget that this is a bullish week. So my take on it is my take on it would be that be short term long, but long term you got a short, and that's for the simple reason that the fundamentals haven't materially altered.
Yeah. Okay, let's pick up on that point, the short-term long and long-term short with regard to the WTI price, West Texas price at the moment. This is the channel that we've been following this, and it's been quite a nice little channel to trade in. We're currently trading at 58.64, just a shy touch of the 60 barrel level. Give us your expectations of where this is going. We've got a little bit of support just below where we are at 58.07, but explain a bit more about what you've been talking about in terms of this price action.
I think in terms of the West Texas, you're looking at a situation where 60 could be sustained round about Christmas. But of course, you know, if you take the whole year as a whole, the average price is much lower. After all, we were flirting with the 20s and 30s at the start of the year. Next year, up and until the run up to Christmas, I think 60 is sustainable, especially if OPEC, as expected, at least on paper, announces a cut. But next year, will the West Texas escape this 55 to 65 range? I'm not convinced. And I think ditto applies for Brent as well. Okay, well let's bring up a chart of Brent as well and take a look at that, because we're talking about a different price level here. The two obviously don't often reflect each other. Here we are at 63.21. This price action has recently topped out at what, about 64.67. Again, talk a little bit more about your expectations of Brent. I think Brent, a lot of people adopt it as a poster child of the global economy. They think if Brent is running higher, will it overshoot? I don't think it will overshoot, because I think if you look at the front month contract and then you go further out, and Brent is still in backwardation, i.e. futures expectations are of a lower price. So you know it's sort of the way you explain backwardation is if you slip, you're falling backwards. Right. So the current price is higher than what people expect 3, 6, 9 months out, and so on and so forth. And again, it comes back to, sorry to sound like a broken record, comes back to the market fundamentals. On the supply side, supply is what it is. OPEC is cutting, but there's, as I mentioned, plenty of non-OPEC oil out there. On the demand side, India seems to be the only player of the big five, i.e. the US, South Korea, Japan, China, and India, of course, that's actually driving. India has recently overtook Japan, as you know, as the third largest importer of crude oil after America and China. And much of the sentiment is predicated on that. And there is a disconnect. Yeah. OPEC expects a higher demand, but the IEA is not singing from the same hymn sheet. So if I gave you a 3-month of March contract for Brent, you'd sell it? I would short it. Yeah. I would short as things stand, even regardless of what OPEC does on the 30th of November. But of course, if you're playing on the next 5, 10, 15 days all the way run up to Christmas or the festive period, I think you could be short-term bullish. You could have a flutter to the upside. Good. Look, we're talking with you again, I know, Friday morning in a live bulletin, aren't we, with an update from Vienna. But Gaurav, in the meantime, thank you so much indeed for joining us with a look there at the oil price as we go into that meeting on Thursday for OPEC. And of course, they'll be joined, as Gaurav was saying, by non-OPEC members, some non-OPEC members as well. Gaurav Sharma is editor at the International Business Times.